You see it at the pump, you see it at the two front, and the second time is the roll-off. The roll-off is $47.5 trillion out of the $9 trillion.
Hi, my name is Katie Durkin, and I am a Senior Vice President here at Gabelli. I am joined today by my colleague Mac Sykes, Portfolio Manager of the Gabelli Financial Opportunity ETF. The fund is actively managed and traced on the New York Stock Exchange under the symbol GABF. Mac joined Gabelli Funds in 2008 and is a former #1 ranked sell-side analyst. Mac, when investors think of financial services, banks come to mind, and it certainly has been a challenging environment recently. Can you talk to us a little bit about your exposure today and what your outlook is going forward?
Thanks, Katie. You're right. Banks are often assumed to be just in financial services funds, but our fund was set up differently in the sense that it has exposure to a number of different companies within the financial services space, including payments, wealth, insurance companies, and also specialty companies. We do have some bank exposure, but right now the outlook for small and mid-regional banks is pretty difficult in my opinion. You have an inverted yield curve, you have worsening credit conditions, and you also have potentially changing regulatory actions, all of which could impact ROEs going forward. So for our firm, we choose to, at this point, look at more of the larger firms. They're more diversified in terms of capital markets, investment banking, asset and wealth management, and are also, for the most part, well capitalized. And we saw a recent deal with the First Republic and JP Morgan. And to the extent that there have been bank failures, it's not atypical. So since 2002, there's been 560 bank failures, 26 per year. And of course, we've had a number of notable ones this year in terms of Silicon Valley Bank and Signature. On the contrary, a firm like First Citizens, which came into the year with plenty of liquidity, was able to take advantage of the situation by absorbing Silicon Valley. Their tangible book jumped from $579 per share to over $1,200 after they consummated the transaction. So within financial services and banking, we see a good opportunity, mostly on the strong side, and the potential consolidation that could lead to from more of these distressed banks that come through the FDIC process.
Thanks, Mac. One of the concerns right now is a recession. So could you talk a little bit about how you're positioning the portfolio in this current market environment?
Right, so that's been a big topic of mine for investors. And my father always said to me, it's a market of stocks and not a stock market. So yes, we do keep an eye on the macro, we look at rates, et cetera, but we build a portfolio from a bottoms-up fundamental process. And so we're looking for companies that even in more challenging economic conditions will continue to do well. One of those companies is American Express. And in this environment today, they're predicting revenue growth year over year of almost up 15%. And that's due to their strong cohort in terms of the younger members, their small business clients, and also a return to travel, as well as what we've been seeing. There's a wonderful management team, incredible brand, high ROEs, and differentiated credit risk because of their spend-centric model, which relies almost 80% of their revenue comes from charge. So there's a bank, financial institution, very well positioned, executing well, and should just do fine, even if economic conditions get worse.
Oh.
So, secondly, Interactive Brokers, which we've always highlighted, is another firm that we believe is in a secular growth spot. It's a global brokerage business with an incredible moat, $12 billion of capital, 2 million accounts, growing at over 20% plus. And what's incredible about the firm is they have 70% margins and is significantly well capitalized. So with good visibility in terms of their client growth, given 2 major wins this summer. And so we see good revenue growth there, even in spite of choppy markets today.
Thanks so much, Mac. Would you also highlight some of the other major trends that you're following today?
Sure. I would like to talk about 2 major trends. First, year to date, you've seen very strong flows to some of the more major wealth platforms. And that's a reflection of higher household incomes, as well as what we believe is a transformational change in terms of the movement of wealth from baby boomers to the younger generations. And secondly, in the alternatives business, just 5% of managed assets are allocated in institutional portfolios to this asset class, which has had compelling results and also offers diversification benefits. So we think over time, you will see more allocations to this space, and just a 1 or 2% shift could represent trillions of dollars. And it could be allocated to just a select few of the higher end, better performing firms. So we think that there's significant opportunity for those firms to benefit, as well as very good economics from those asset flows. And then you need very little capital at the firms to handle that.
Mac, thank you so much for sitting down today. Your insights are always appreciated, and I look forward to catching up again.
Thanks, Katie.